Such an interesting and important time for the major stock indexes as we come into the second week of the third quarter and the beginning of earnings season. Hello, I'm Bruce Fraser, your host, and this is Power Charting. So today, let's have a brief update of the stock market, looking at the Dow Industrials, interesting picture, and then a look at put call ratios, two bullish percent studies, the S&P and the NASDAQ, and then we're going to do a series of trend analysis and point and figure studies on the NASDAQ 100. And finally, a case study on the broadening formation, which is quite interesting. So to begin, here is the Dow Jones Industrials, and we had a June peak with a climax that occurred into an important trend channel. This is 60-minute data and a throw over of two trend lines here at the peak around the second week of June. We had two power charting episodes where we showcased at the time what was happening. A subsequent decline, a reversal down, was quite dramatic and went towards the bottom of this large trend channel. And at the time, we said there would be a range-bound condition for the foreseeable future. The rally into and climactic surge into June, we believe, was a form of window dressing, as institutions rushed purchases into the end of the second quarter, and subsequently demand tailed off and a trading range followed. Often you'll get a June peak or a peak in the last month of the old quarter, and then you'll get a peak in the new month of the next quarter. Appears to be happening here. This is an interesting construction because it has elements of absorption that indicate that there may be a basing process occurring that is forming for another rally phase in the future. So right now, slightly above this trading range area, this is a point of vulnerability simply because there is an important trend line right below. It would be a very short move to get to the trend line and through the trend line. And so we will watch closely. Could be related to earnings reports. Here is a closer up view of the chart that we were just studying. Two trend channels, a steeper one. Both of these, once they were broken at the same, roughly the same time, the weakness was profound. And so a touch of the trend line was reversed up. Another touch of the trend line was reversed up, but you can see so far we're not getting to the top of the channel. There's a gap here which shows a bit of excitement, and then an attempt to come back. So far very shallow. I consider this so far to be quite bullish looking, and we would just simply want to see the Dow Industrial stay above this trend line. Now, two important bullish percent studies which have been extremely useful to us. We can see back January, February, we showcased this data in the S&P 500 over here. There was a divergence that occurred into the February peak as the S&P was making higher prices. This divergence was a warning and subsequently a very sharp decline into the March lows. Well, the rally phase has gone up to that 90% level, which shows that there's a tremendous number of stocks on bullish percent buy signals. And you can look that up at StockCharts University. Now there is a divergence, and this divergence from this point here to here is pretty steep and shows the potential for vulnerability. This is the June peak in the market. Here is the July peak. The number of stocks that are participating in the attempt to go up to the June highs in July is showing that there are fewer stocks participating in that rally attempt. That is a divergence. You can see that right here on this price chart. And so this attempt to go up doesn't have the strength that was occurring in the June rally. So classic divergent behavior. Looking at the NASDAQ has really been the star here all along, and we're going to talk a lot more about the NASDAQ if I can just keep going here. So you can see attempt to throw over. Well, the NASDAQ was very strong and staying in that 85 to 90% range, which is about as high as you can go. And there is a divergence here, and this divergence continues to be in the high 80% area. Here, the divergence, we have the NASDAQ bullish percent below 80, and it's starting to taper off. So this divergence is a lot more disconcerting than the whole structure, but you can see here that if there's an attempt now after this divergence to break down below, say, this trend line, that would be a sign that the NASDAQ 100 is losing internal steam. And this is with a quite dramatic rally phase. So notice the accelerating climactic surge here, and that is associated with a upward move in the bullish percent to a lower high and below 80%. We will be watching this closely. Sentiment, you can see in the put call data that June, which was the climactic surge in the S&P and the Dow, which is this chart here, the green line at the top, you can see, and we documented at the time, the climactic surge in June was associated with extreme call buying, extreme bullish speculation here at this area, and much greater than the record levels that were achieved in January and February before the big decline. Well, look what's happened. As the S&P has gone back up to the June highs and is testing the June highs in July, the call buying is extreme again. So there's more call buying taking place and matching the June levels, far exceeding the January, February levels. And this extreme call buying is occurring with diminishing bullishness in the bullish percent data, meaning fewer stocks are participating. This indicates it's harder for option traders to be able to make money on the bullish side with the deteriorating breadth as measured by bullish percent. This chart here is from the blog that I just wrote. Please go have a look at that. We're going to spend more time on this today and look at more levels and layers of NASDAQ 100 trend characteristics. So reverse use of trend lines, throw over an overbought condition here, and look what happened and this was the day that I published the blog. I was writing it in these days here. Big reversal down into the channel, held the channel, and now look today, we're back into the channel below the trend line, reverse use of trend line construction. Look how beautifully this trend channel picked up really important, the buy points in the uptrend in the NASDAQ 100. Trend line analysis is just the best. And so here, especially the way Wyckoff does it. So here is a point and figure chart that we're going to look at in a second. Gives us a count to 11,564, 10,683, and we have gone up to the 11,000 area, right into the middle of this count range, and then turned sharply off of that on volume. So very interesting. And I believe that this could be a sign of a range-bound NASDAQ 100 index. And so we would look to form resistance up here, and wherever this decline stops, we would look for support and watch that very closely. This point and figure chart is really interesting because it is percentage scale, meaning it's logarithmic rather than arithmetic, which is the normal way that we construct point and figure. Percentage scale is tricky. I'm doing a lot of work on this for horizontal counting purposes, and so I encourage you to be careful with it, experiment with it. I always refer back to my horizontal arithmetic scaling to be sure, and we do have point and figure charts, arithmetic scale, that have given us really good counts up to the area that we're in. So here we have 23 columns at 2% scaling. The way to think of this is that we have in this base, beautiful base, this is all in the month of March where the low was being formed for the big, beautiful uptrend that followed, is that there were 23 columns of count giving us 23 2% periods of upward movement. So 23 net up movements of 2%. And so that's the way to think of this. It's pretty dynamic actually to do logarithmic scaling. Again, it is tricky and it is different, and I will be talking much more about this in the future. So here's our count, 10,683, 11,564. We're right into that count area now. I think we went a couple boxes higher from when I constructed this on the 10th. And so here is a beautiful classic base intraday. This is 60-minute data, 23 columns of 2% advance in the NASDAQ, which worked out to be something like 57, 58% advance. So very spectacular, and this technique worked quite well. Read more about it in the blog I just published. Okay, here is a trend channel. We're going to widen out our trend channel analysis on the NASDAQ 100. And here we're looking at the Qs, triple Qs. And so here is reverse use of trend line. These are the 2 points that we've used. You will see here that this is 2018. So 2018, we have 2 adjacent peaks. We draw a trend line. We have a minor throw over in 2020 at the January-February peak. And then we draw a parallel at this low at the end of 2018, which was the October to December decline, very important decline, more on this later. And look at how well this parallel, we always draw the parallel as a dotted line, is how well this captured and retained the downward move in the Qs into the March lows, which we just looked at the point and figure chart of this. And here is the magnificent rally that occurred subsequently. We have the point and figure counts that have taken us up into this range. And it is a significant throw over of the trend line. And here we are. This chart is as of the 16th today. And we can see that there's a very wide range here. We would like to see this stay out of this trend line above it and consolidate for continuation of the move. But we're realistic. We are technicians. We're Wyckofians. We will be watching to see if the triple Qs can come back into this trend line. And if it comes back below this trend line, we're going to be defensive and careful. This is a good place to think about where stops should be placed to protect capital. Okay, so this is a really important throw over where we are, and also represents the completion of a point and figure count. Remember, with point and figure counting, is that just because we fulfill a count, and we may have further to go in this count, is we at that point could build another cause for another move up. It's too early to tell. It just tells us we've used the fuel up, need to create more fuel. Later on, we may determine that distribution is at work or reaccumulation. So here, we are going to be watching this closely, but we think a point of vulnerability is formed above this very important channel that goes all the way back to early 2018. Here is a further outlook at the NASDAQ 100, and this takes into account two periods: 2005, whoa, this is really big, 2007. We draw a trend line on two adjacent peaks. And this is what I love about StockCharts.com, is that we can annotate these charts, put them in special files, and then refer to them constantly over time to see how they're progressing, because our annotations are saved. This is great stuff. I love, love, love the annotation features in StockCharts.com. Look at the touch here. Wow, this is terrific. And then another touch and a throw over here. This is the February-March decline that goes all the way down to this lower trend line. We'll talk about that in a second. And then this 4-month advance, this is monthly data. This 4-month advance right here is the area we just looked at with the overthrow that we just saw on the daily data and the weekly data. And we have a throw over on the monthly data. So 3 levels we're looking at a potential throw over. We want this to stay up here, not to come back into especially these 2 very important trend lines here and here. So look at how they're converging. We prefer to see this stay above or at these 2 trend lines and then continue on. So we don't always get what we want. So that's one of the lessons I had to learn in my trading. Look at the beautiful relative strength here. Wow, it's just the leadership from the NASDAQ is just fabulous. So here are 2, got to keep track of the time. Here are 2 points here, 2 peaks adjacent. We draw a reverse use of trend lines here. The blue one is its own trend line construction, 2 adjacent lows. This is in 2010, 2011. Here's 2011, 2012. And so early in the uptrend, the stride is set for the rising trend. This is logarithmic scaling. Look at the touches on this traditional trend line construction here and here and here, and these are all wonderful buy points. This is the March low, the big decline. This is the October to December decline and the beginning of the important rally in 2019. These are wonderful touch points. So now, here is the reverse use of trend lines. Throw over here, throw over here, throw over here. And so we will be watching this closely to make sure that the trend continues upward and that we maintain relative strength. Okay, now let's go back and look at the NASDAQ 100 in the 1990s. We can see here trend line construction here and here with this is reverse use. Here is a parallel low, dotted line, and here it catches the lows here, slightly goes through here, but look at the beautiful rally that followed. Then we have a dramatic rally from 1998 to 2000. And notice the leadership from the NASDAQ 100. Slightly different from what we have today, but the NASDAQ 100 today is remarkable leadership. And so this is from slightly over 1,000 to almost 5,000, around 4,800. And so a substantial percentage move in the NASDAQ 100 here. Then a sudden break, dramatic break in 2000, an attempt to rally up for 2 quarters, which is a test to a lower high and a failure. It comes on suddenly. And so the sudden turn of behavior from leadership to laggard is something that happened back in 2000. And this is what I believe we have to be on our toes about here. Here is just the S&P 500. You can see more traditional distribution here, classic trend line construction throughout, nice touch points, throwovers, and then the big bear market. Okay, so here is again the NASDAQ 100. This is the chart we were just looking at. And here's our trend channel throw over at the end. I want to show you the relative strength. This is weekly data. The relative strength is just in this ripping advance that just goes up and up and up until all of a sudden, from a very overbought condition, look how far away it is from the moving average on both price and on relative strength. And when it reverses instantly and goes into a downtrending structure. So my recommendation is to have trend lines drawn that can be tell you when there is a important break of a near-term channel that can warn you that trouble is upon us. And so this maybe is an example that you can see in my most recent blog. And I'm running out of time. So here I'm going to very briefly show you this beautiful rising trend in the NASDAQ. It's a different picture than 2000, but still the leadership characteristics here are stunning. This is a different trend line construction. Here are the 2 peaks here and here, trend line drawn, throw over here, and we want to see this stay up here and not come back into the channel. This is kind of a mess. I apologize. I've drawn a lot of trend lines on here, but you can see that the trend line here, reverse use, parallel here, quite a bit lower from where we are right now. And then this trend line is drawn off these 2 peaks right here and these 2 lows, this parallel, and this is quite a bit lower than where we are. But notice these 2 points and how it captures this oversold condition and this oversold condition where it reverses up, and this has been just a fabulous uptrend in the NASDAQ 100, and it really has been a champ and the true leader of this bull market. And for contrast, here's the Dow Industrials, which has been making higher highs and lower lows, which is the subject for our next discussion, which is the broadening top formation. I've told you about the 62 analog, where we had a broadening formation and then went up to the 1963, went up to the highs and then went onward. So this is my preferred scenario. Not going to talk about it today, but I want to talk about the broadening formation because this is a classic rare type of distribution pattern. And I'm going to read this. This is from our very own John Murphy. Professor Murphy was so good to me. I have 3 copies of his book, and I used his book as my textbook for years at Golden Gate University. Professor Murphy's book and Professor Pring's book, and Professor Murphy was so generous with his time with me to help me to use his book as effectively as possible as a textbook, which is why he wrote it. It should be in everyone's library. And so here, and this is a good example of why. So the broadening formation, this is a type of expanding triangle, usually occurs at major tops. It shows 3 successively higher peaks, 2 declining troughs. So here they are, 3 peaks, 2 troughs. The violation of the second trough, which is here, that's the violation, completes the pattern. This is an unusually difficult pattern to trade, and fortunately is relatively rare. Difficult to trade because trend followers will tend to buy the breakouts, and so or sell the breakdowns, and they get whipsawed here with this pattern. So let's move on, and here is an example of the Dow Jones Industrial Average back to 2018 and what's occurred since. We have made the case for the 62 analog where this could rally upward and go to new all-time highs. That's my preferred scenario, but I believe that we have to talk about the broadening formation. So here is the broadening formation, and we are going to compare it to the Dow Jones Industrial Average in the 3 minutes we have left. So we're going to go really fast. So point 1 on the classic schematic, and here is point 1, which is the buying climax, January of 2018. Point 2 is the automatic reaction. We're comparing, we're using Wyckoff in our nomenclature here. And so here is point 2, and that's the reaction after the climax in January of 2018. Point 3 is a higher high, and this is the secondary test that you can see at point 3. And then what we're calling a sign of weakness at point 4 is this area right here. Now, this is where it gets quite interesting. Point 5 is another higher high, megaphone pattern, broadening formation, diverging trend lines, and you can see those in the Dow Industrials. And so here's point number 5 at the up thrust after distribution, where the dramatic failure occurred that took us to point 6. Now, this is the place where you break down below the declining trend line under the market here, and this is the classic sign of the completion of the structure. Now, point 7 is a rally. Typically, Professor Murphy tells us that it goes up about 50%, but we don't have a hard, fast rule. There's not that many examples of the broadening formation at work here. And so here is point 7, and point 7 is the rally phase that we're at. I have a reason for being concerned about this particular point, and this is the reason we're talking about it now, is because of where the Dow Jones Industrial Average is in relationship to the structure. And so then finally at point 8 is the beginning of the important bear market downtrend. I'm not predicting this, but I believe if we didn't talk about this and I came back and showed it to you later, and it did turn out this way, you'd probably be unhappy with me. So, and I certainly don't want that. So here's the buying climax peak, January 2018. Well, look where we are. Horizontal line, we draw from the buying climax peak, and you can see this is exactly where we are now. And so this is the reason I think this is such an important point in this chart, is because we are up against classic long-term resistance. We're going to be watching this closely. We can see the uptrend here. If we break this uptrend, we will be most concerned about a downtrend resuming. So this is not preferred, but I want you to know about this. And with this, it's time to go. Thank you so much for being here. See you next time.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.